The French and the Germans appear to have worked out their differences on a second bailout for Greece, potentially opening the way for a more comprehensive solution to Europe's debt crisis at the summit in Brussels. Well, to explore this a little more, I'm joined now from London by Gabriel Stein from Lombard Street Research. Gabriel, welcome to the programme.
Thank you.
Well, now, this is quite a big development, isn't this? Germany and France appearing to have a meeting of minds now.
Yes, absolutely. But let's be clear, it comes rather late in the day. The reaction of euro area politicians throughout this crisis, which really erupted early last year, has constantly been to come up with stopgap solutions, a sticking plaster solution, and then these have been blown out of the water. But the result has been that the crisis has spread. And of course, what we've seen in the last week or so is that the crisis has spread even to Spain and Italy, which are seeing their borrowing costs rise towards uncomfortable and unsustainable levels. And that puts tremendous pressure on today's summit. I usually think summits are meaningless, but I think today's euro area summit is absolutely crucial.
Now, there's been speculation about a possible bank tax, also about some sort of rescheduling of bonds. What are you hearing?
Well, the main thing is that it seems the bank tax is now off the table. That was a French idea, and it seems that they've had to give in there. It's terribly difficult to judge what is likely to happen because this is all politics. But yes, some form of rollover and or extension of debt, very likely.
Now would that lead to a technical default in any event, even if there was a rollover or a rescheduling?
Almost certainly, yes. And in fact, you had the Prime Minister of Luxembourg, Jean-Claude Juncker, who is the head of the Eurogroup, that's the countries that share the euro. He said this morning that a selective default is part of the options. It may be that this will involve unilaterally cutting the rate of interest that Greece pays, certainly cutting the rate of interest they have to pay on their bailouts. There are all sorts of things that are now in the air. There's been talk of euro area bonds. The president of the ECB, Mr. Trichet, wants to see a euro area finance ministry.
And what does this all mean for the euro? Because I noticed that a group of leading European economists have written that for the first time, the survival of the euro is at stake.
We're now getting very much more into politics, but history is very, very clear. A monetary union between equal states has to become a fiscal union. Otherwise, it will not survive. And so the euro has to integrate, the euro countries have to integrate further. The question is, are the citizens in the euro area countries, in particular in what I would call the payer countries, Germany, Finland, Netherlands, are they prepared to take on essentially unlimited commitments to pay until the southern countries have shaped up their act? I don't think they're prepared to do that yet.
Yes, as you mentioned earlier. Yeah, well, I was going to say, as you mentioned earlier, it is Italy, it is Spain now, and again, there was talk about trying to create a firebreak. There seems less focus on that today.
Yes, but if they don't create a firebreak today, then I think the next fiscal crisis will not occur in 6 months or 3 months. It's more likely to occur in the next couple of weeks. I want to make a point referring to something that was said earlier in your program, talk of using the European Financial Stability Facility, the EFSF, the bailout fund, to buy back debt on the secondary market. There's a problem with that. If markets know that the EFSF is buying back debt, the price of that debt will rise very, very swiftly.
What does this all mean for the European Central Bank now?
The European Central Bank is the great loser in all this for two reasons. Well, for one main reason. The ECB, remember, for years they lectured politicians on the need to how to run fiscal policy, perhaps justified, we would say now. But every time the ECB has put up a principle or drawn a line in the sand, if I may mix my metaphors, they've been forced to give it up. They were not going to accept bonds as collateral if they weren't rated at least a certain level. They gave that up. They're accepting all Irish, all Greek, all Portuguese bonds. They were not going to buy bonds. They have bought bonds. They are now saying they won't accept defaulted Greek bonds if Greece defaults. I think one of the things that will come up today is they will accept Greek bonds as collateral. And part of the problem here is that the ECB has also lost sight of what a central bank's main function is. They are concentrating on inflation control and price stability, and that's terribly important. But the real function of a central bank is to ensure financial stability, and this is where the ECB has failed.
So very briefly, what do you think needs to come out in terms of a clear decision today?
Well, I think the ultimate firebreak would be a clear joint and several guarantee of all debt in the countries in trouble by the entire euro area, combined with steps outlining a shift towards a fiscal union, a transfer union, that would certainly stop the rot, and I don't think it's going to happen.
Gabriel Stein, thank you very much for your perspective today.
Well, thank you. Thank you so much.